Hi, everyone, and welcome to the Strategic Wealth Strategies Podcast. I'm excited to welcome the host of the Strategic Wealth Strategies Podcast, Alan Porter. Alan, what's going on, man? How are you?
Hey, it's another beautiful day here in North Carolina. I'll probably go play some golf later on today. How you doing?
I'm doing fantastic, and always a beautiful day anywhere in the summer. We'll see what happens when it gets cold. I might not be saying the same thing, but what is our topic? What are we going to cover today?
Well, I've got on this a little bit, but I want to go into a more explanation about becoming your own financial institution, never having to borrow money again. And I think people will get a better perception of what this does and the benefits that it gives them. But I got a short PowerPoint again presentation for this, and I've got I'm doing probably these debt-free for life cases, probably 10 a week now for people, and they just can't believe it. They say, Alan, this is too good to be true. I said, it's too good to be free. It's just a matter of education and knowing what to do. But I'll show you this, Neil. I think people will like this. Become your own financial institution and pay yourself compound interest and not the financial institutions or the banks. And people don't understand that you can become your own financial institution, your own bank, and pay themselves compound interest and not the financial institutions. Because when you pay money to a financial institution, that's gone. It'll never compound for you again. So what I show people as an example, you want to buy a car and you want to buy a car for say $50,000. Now you can go to the financial institution or bank and borrow that money. If you do get the loan, they don't make the payments. They're going to ruin your credit and repossess the car. But the thing is, you're paying that financial institution, that bank, compound interest, and you've lost that forever. It'll never compound for you. Or you can borrow money from your cash value life insurance policy and pay yourself compound interest instead of the financial institutions. Now, here's an example. This is just a example of a policy that I did for a gentleman. He had $350,000 or $300 some thousand in cash value. And I showed him what it would do on his policy. He said, well, let's see what a $50,000 loan would look like to myself. So I said, okay, here's the $50,000 that you're taking out of the cash value. This is you paying yourself back at 0% interest, $10,000 a year for 5 years. Now, this is what your cash value was before the 327, and this is what your cash value was afterwards, the 286. But at the end of the 5 years, not only have you paid all of this money back to yourself, the cash value in your policy is $437,000 because you're being paid dividends even on the money that you borrow. They're paid dividends in that original $303,000 in this.
Wow.
And people don't understand that. I mean, this guy, even if he buys a house, he may not have to go to the bank. Of course, it's how big the house is, but he may never have to go to the bank again. He'll never have to borrow money to do anything because all he has to do is have money in these types of accounts, these cash-free, tax-free, I call them SDICs, specially designed insurance contracts. And they're specially built for this particular reason. And we show people how to do this, and they'll never have to borrow money from a bank institution again. They'll be debt-free for their life, and they can do many, many things. But here's what you would have done. All right. You could have paid for the car, paid for it 5 years, $50,000 again. You lost that money. The car may be worth $30,000 as an example. But if you borrow that money again from your policy, you pay yourself the compound interest because that money comes back to you, compounding in a tax-free account. You paid yourself back the entire $50,000, so the car didn't cost you anything. In fact, you made money on the car because they paid dividends on that $50,000. You own your car, and the cash value in your account is tens of thousands. When in this case, it was $100-some thousand more. And the death benefit is hundreds of thousands of dollars that protects the family, and you can use for long-term care. And people just do not understand this. They've listened to the propaganda of Wall Street and the banking institutions, and come borrow from us. We got low rates, all this. Yes, but you're compounding the interest for you. And just like credit cards, we've gone over with effective interest cost on things. People say, oh, I got a 2.75% rate on my mortgage. I said, what's your effective interest cost? Well, I don't know. Well, this one gentleman I had, his effective interest cost, was over 49% on his 2.75% mortgage. And he says, how's that possible? I said, because it's not going to get down to the 2.75 until the last couple months of the mortgage. So I said, this is what we want to do. We'll take that money you put in your 401k. We'll put this away because you're paying 46 cents out of every dollar he was paying was going to compound interest for financial institutions. So when we did this, I asked him, I said, how long is it going to take you to pay that off? He said, approximately 20 some years. We're paying extra on the mortgage. I said, we're paying off 14 years early. We're going to put $130,000 in your tax-free bucket of money that you become your own financial institution. And your death benefit is hundreds of thousands of dollars. He says, Alan, sounds too good to be true. I said, no, it's too good to be free. It's just a matter of education and knowing how to do these things and talking to the right advisor. But get a load of this. Look at the benefits you gain. The money's tax deferred. And this is just part of it. The money's tax deferred. Your distributions are tax free. You have unlimited contributions. And not like a 401k or an IRA or a Roth 401k or IRA. It's tax-free money for long-term care. And people are not prepared for long-term care. And it costs between $50,000 to $200,000 a year and goes up every year. You become your own financial institution, paying yourself the compound interest and not the banks. It avoids the taxation of Social Security and the means testing for Medicare Part B. Neil, that alone is in the tens of thousands or thousands of dollars per year.
Totally.
And I bet your CPA and your financial planner never told you about this. It avoids probate. Probate is huge. You basically, I call it a lawsuit that's initiated by you that you're going to pay for and you're going to lose. Because if you don't have the right exit plan when you pass away, the government takes control of all your assets. They'll sell your assets to pay the taxes. And what's really criminal is attorneys get 6 to 12% of that estate for legal fees. This is huge. You're protected from lawsuits, liens, and judgments in almost every state. It's the greatest wealth transfer vehicle available. That's why wealthy people buy hundreds of millions of dollars of cash value life insurance to pay the taxes so their family can keep the estate. It's the best tax code approved, tax-free retirement system available today. I know nothing better because a stock portfolio can't even come close to these benefits. It's the best college funding vehicle available. In fact, I've got 2 whole life policies for my granddaughters for the college funding. It beats the 529 plan, all the pieces, because there's no risk. The only financial vehicle that will protect you and your family if you live too long, die too soon, or get sick. I mean, I found this out many years ago when my daughter-in-law died of pancreatic cancer at the age of 39. If it had not been for the terminal illness rider on her life insurance policy, which was completely tax-free in the hundreds of thousands of dollars, my son would be bankrupt because he's 100% disabled. And it took a huge financial strain off me. Now, Neil, I've gone this over. I mean, I've said this on many of my videos. I'm very, very passionate about what I do because I change people's lives. My number one goal, both professionally and personally, is protection of the family and protection of their assets. If anybody wants to talk to me, there's my address in Fayetteville, North Carolina. But my phone number is 910-551-1046. And my email address is strategicwealth0@gmail.com. And I just want to thank everybody, for watching this short PowerPoint presentation. But I think it gets a point across, Neil, that a lot of people don't understand, and they need to take advantage of it.
How much do you have to put up front to a cash value life insurance when that scenario? How much money do you have to put in first?
Well, it all depends, Neil, because you can't put too much money in a life insurance policy or it becomes a modified endowment contract and you lose all your tax advantages. But if you put like, I don't know, I've done policies from $100 a month to $100,000 a month. But the larger money you put in there, the faster your account will build up. But if like you put in $1,000 a month, just like this guy did, I told about here. He was out of debt in 10.1 years, 14 years faster than we had before. And then he just paid himself back.
That's crazy. And it became worth that amount of money. It's a no-brainer. It's an absolute no-brainer.
Well, look at he's leveraged his money in 3 ways. He's getting paid on the money that he's borrowing. He's got a tax-free bucket of money. He becomes his own financial institution. He's paid dividends on the original cash value of that, even though he borrowed $50,000. And he has a death benefit that will protect his family in case he dies too soon or used for long-term care, tax-free. There's no other financial vehicle that even do this. And also, it protects you from many risks in retirement. Number one risk in retirement is running out of money before you run out of life. Longevity risk, which is a risk multiplier, and sequence of returns risk. We've discussed this before, where you have a loss in your stock portfolio in the first 3 years of a retirement, it will devastate you because you're taking money out of a depleting asset. The only way that you can keep that money is you reduce your distribution rate. And people don't want to have a less, I want people to have a good retirement, a less stressful retirement. And it's been proven by Harvard that people with guaranteed income have a less stressful, more happy, and healthy life, and a longer life, because they don't have to worry about the ups and downs of the market. I can't imagine people retiring right now what's going on with the government and the stock market, because things just from one day to the next is different. I don't know what to say to people sometimes.
You think about it, you're putting $1,000 a month or $500 a month or 100 or 10,000, whatever number you're putting in. That money's not going to disappear. When you put it in the stock market, you never know. It could be gone.
That's exactly
It could be
right.
absolutely gone. And everyone says to go in front of inflation. Would you rather have $0 and stick with inflation to catch up by you putting all this money in for inflation, or have the money still that you worked hard for and not lose it?
Yeah, that's exactly right. I mean, it's crazy. It's crazy about this Wall Street propaganda. Everybody said, well, so the Wall Street's come back to what it was a year and a half ago, whatever. But that was on about 5 different sectors. I mean, overall, the other market lost 10%, 90%, 95% of the market lost 10%. And it's just like in 2000. 2000, you had the lost decade. If you put $100,000 into the market in 2010, you had 96,000. That doesn't include fees. And as I've told you before, a 1% fee in a 401k over a 30-year period will reduce your income by 1/3. And the average fee for a 401k is 2.99% across the board. People are going to have less than half of their income when it comes to retirement because of fees.
It's crazy. All of those things are happening, Alan, and the only thing we can do is basically make the right decisions. And then once you pay off all your debt, you have other programs when people get about 52, 53 years old, right? And say, okay, now it's time for annuities so that you get guaranteed income for life. Because it's not about your assets, it's about your income at the end, right?
Exactly right. Because, it's just like life and cash value life insurance. That's guaranteed income also. But like with annuities, as I've said before, you can have $1 million in a stock portfolio at a 4% distribution rate, and that's around $40,000. That's $40,000, but that's not guaranteed. You'd only need $650,000 approximately in these certain fixed and fixed indexed annuities that I sponsored to give you the same $40,000 a year, and that's guaranteed for life. And so that leaves you $350,000. You can turn it into a Roth. Never pay taxes on it. Never, it won't affect taxation, Social Security, the means tested Medicare Part B. There's no required minimum distribution.
And when you have these conversations with these people from the Debt Free for Life program, how surprised are they when they hear this stuff?
They're very surprised because they've never heard of it before. They hear Dave Ramsey all the time. Dave Ramsey, Dave Ramsey. Well, Dave Ramsey wants you to pay the money to the financial institutions. I've gone over this. Dave Ramsey, you got 2 bills. You got credit card and student loan. You've got the minimum payment on both. Well, you make the minimum payment, but you got $500 extra. He wants you to put it towards the credit cards. And when that's paid off, then he wants you to take both that $500 and the minimum payment for the credit cards and pay it towards the student loan. Well, it's paid off, but you're in the same boat you were before. You're broke. And if you want to buy something, you have to go to the bank or put on a credit card. Dave Ramsey, he gets touted a lot on TV, but some of his ideas, we've blown him completely out of the water. I can't even talk to him on the radio show. But it's a matter of education. It ought to be taught in high school, but it's not. Like I said, I've got doctors that have PhDs in accounting and finance, and they have no idea what I'm talking about.
All right. So the best place again is call you at 910-551-1046 or Strategic Wealth, the number 0 @gmail.com. Appreciate it, Alan. Look forward to the next topic.
Okay. We'll talk.
All right. That's the Strategic Wealth Strategies podcast, guys. Take care.